All right, so Elecon Engineering's latest numbers are out, and honestly, they tell a really fascinating story. You've got this amazing, explosive growth in one area, but at the same time, you've got these global issues kind of slamming on the brakes. So let's dig in and figure out what's really happening here. The core of this whole thing, it's really a tale of two divisions. I mean, the top-line numbers, they look pretty good, right? But the real story, the interesting stuff, that comes out when you look at how their two main businesses are basically in a tug of war. And that's exactly what we're going to unpack. Okay, first things first. For anyone who's not familiar with Elecon, let's get you up to speed real quick. We're not talking about some small-time shop here. These guys are a serious powerhouse in the engineering world. So what do they actually do? Well, think of it in two big buckets. First, they make these massive, heavy-duty industrial gearboxes. The kind that power everything from giant steel mills to huge ships. And second, they build what's called material handling equipment. Just picture those enormous conveyor systems you see at ports or mines. That's them. They're a huge deal in India, and they're all over the world too. We're talking a footprint in something like 95 countries. All right, time to get into the nitty-gritty, the numbers. Because on the surface, the Q2 results look fine, solid growth. But remember that tale of two divisions I mentioned? Well, this is where it really comes to life. You just have to look one level down. So on one side of the story, you've got the Material Handling Equipment Division. They call it MHE. And wow, did they have a killer quarter. Revenue just exploded, up a massive 33% compared to last year. And this wasn't just some lucky break. It was driven by real, booming demand from huge sectors like power, cement, and ports. Just an absolutely stellar performance. But then, you flip the coin. You look at the other side of the business, the Industrial Gear Division. And keep in mind, this is the bigger part of their company. So what was their growth? A much more, modest 9%. Now, hey, growth is growth, right? But 9% feels like it's on a different planet compared to the 33% we just saw from MHE. And this really lays it all out, doesn't it? You can see it right there, side by side. 33% growth for MHE and just 9% for gears. But wait, here's the key part, the thing you really need to pay attention to. Look at the order intake. That's their pipeline, right? The future business. MHE's new orders shot up an insane 84%. And even the gears division, the slower one, pulled in a very healthy 15% jump. So what does that tell you? It tells you the underlying demand is still super strong for both parts of the business, even if the revenue doesn't show it just yet. Okay, so you're probably wondering, what's putting the squeeze on the gear division's profits then? Well, management gave a few reasons. For one, they're paying their people more. Simple as that. There's also been a shift in the kinds of products they're selling. And on top of that, they're basically speeding up how they account for the cost of new equipment. It's kind of an accounting thing. It doesn't actually cost them cash right now, but it does make the profit number look a little smaller for a bit. But it wasn't just stuff happening inside the company. Oh no. There were some big things happening out in the world that were having a real impact, especially on Elecon's international business. And you don't have to take my word for it. Listen to what the chairman, Prayasvin Patel, had to say. He basically said that because of all the geopolitical stuff going on in the world, some of their international customers, who are totally sold on their projects, by the way, have just had to hit the pause button for a while. Now, this is the key. The orders aren't gone. They're not canceled. They're just on hold. And here's why that's such a big deal. Look at this. Yeah, their home market in India is the main event, almost 80% of their revenue. But that overseas business, that's still a solid 21%. Think about it. When more than a fifth of your business suddenly decides to take a breather, you're going to feel that. No question. Even if you're pretty sure it's just a temporary thing. So, okay. We've got these challenges, these headwinds. What's the plan? How are they going to navigate this? Well, this is where we get to see Elecon's game plan for the future. And let me tell you, it is pretty ambitious. First up, you have to look at their order book. I mean, it is absolutely booming. Even with some of those international projects on pause, new orders still jumped 28% from last year, hitting almost 700 crore rupees. That is a huge signal that people still want their stuff. In fact, more people want their stuff. This is the foundation they're building on. And they are absolutely putting their money where their mouth is to get ready for all that new business. They're dropping a massive 400 crore rupees on what's called capital expenditure over the next 3 years. And this isn't just about making their factories bigger now. This is a really smart investment in better tech to improve quality and just get more efficient at everything they do. Okay, now check this out. This is their big, long-term play. By the year 2030, the company wants exports to be fully half of their total revenue. That's a huge strategic shift. So why do it? Simple. It's a hedge. If things ever slow down in India, they'll have a strong international business to keep them steady. It just makes the whole company tougher, more resilient. And a huge piece of this growth puzzle is defense. I mean, we're talking big-ticket items here. This timeline gives you a perfect snapshot. They're in the running for contracts on new warships this year. There are even potential orders for a brand new aircraft carrier on the horizon. And those huge orders for the P-17 Bravo project, they're expecting those to be finalized late next year. We're not talking about small jobs here. These are massive, multi-year deals. So after a quarter that was, let's be honest, a bit of a mixed bag with all those delays, what's the mood from management for the rest of the year? I can sum it up in one word: confident. So where is all this confidence coming from? I mean, what's the bottom line? Well, get this. Despite all the challenges, management is doubling down and sticking to their original goals for the entire year. Let's take a look at exactly what they're promising to deliver. First, on revenue, they're guiding for 2,650 crore rupees for the full year. Now, let's be real. To hit that number, they're going to have a really strong second half of the year. But management is betting that their new capacity and that gigantic order book are going to get them across the finish line. And second, profitability. They're aiming for a full-year EBITDA margin of 24%. Now, that's just a fancy way of talking about their operating profit. What this really is a direct signal from them saying, yeah, we see those margin issues in the gear division, and we are confident we can fix them and get the whole company's profitability right back where it needs to be by the end of the year. And that really brings us to the big final question, doesn't it? On one hand, you have a company with a record-breaking pipeline of future work and a really solid growth plan. But on the other hand, they're trying to execute that plan in a world that's, well, let's just say it's pretty volatile, a world where huge projects can just get put on ice. So can Elecon actually navigate all these choppy waters and deliver on those big promises? That right there is the story we'll all be watching.